Hi there, this is Stef with Team Matt and Stef, and today is the first week of October 2023, and I'm bringing to you a state of the market. Last week at the REMAX Activate conference in Vancouver, we had the absolute privilege of listening to Benjamin Tal, the chief economist for CIBC, explain what's going on with the Bank of Canada, with interest rates in general and what he expects to happen in the future, what's happening right now with inflation in certain sectors of the economy, all very interesting stuff. Taken from that, dialed down to understand what's going on in our housing market. Firstly, inflation happened. We knew it was going to happen with regard to the pandemic. We had a massive decrease in supply in various sectors of the economy, commodities, all sorts of things. We had a massive increase in demand for certain things, for goods, for home goods, for housing, for a lot of different things as well. And we had money being pumped into the economy like it was going out of style. Now, this was necessary. It was absolutely necessary for the Canadian government and the US government to feed people, to make sure people could pay their rent and their mortgages. But we knew we would pay for it on the other side. None of that was a surprise. We knew that interest rate hikes were coming despite those low rates during the pandemic. So we expected the Bank of Canada to raise rates. What we didn't expect was this sort of softer landing. We expected the Bank of Canada to be able to bring rates down sooner than they have. And this is really interesting. So what we were presented with on Friday, which I thought was interesting, was the reasons why we're experiencing this softer landing. So 96% chance in August of a recession. Economists predicted in Canada. We did not experience that. And here's why. 1.2 million people flooded into Canada during the pandemic over the last couple of years. These people buoyed the economy. So they kept that demand a little bit higher than the Bank of Canada would have liked as the interest rates were put into place. This actually helped us out a lot. It buoyed our economy. Thank an immigrant today. The other thing that buoyed our economy was the $165 billion in savings that Canadians amassed during the pandemic. So we weren't going out to the movies, we weren't going out to dinner, we weren't going on vacation, we were saving our money. And that helped us over the last 18 months as those interest rates went up. So we were able to use our savings to soften that blow. Now, while those interest rates were higher, other things came into play that indicate disinflationary pressures in the market. So the Bank of Canada was able to use their interest rate tool to help these disinflationary measures along, and we explain that in our blog post, while Canadians were able to use their savings. So this was really interesting. Now, and only now, that Canadians have gone through their savings accounts and are now moving on to using their credit cards more and amassing more credit card debt, is the Bank of Canada interest rate hike having the desired effect. Yes, I said desired effect. The Bank of Canada wants to curb that demand, and we haven't been able to curb it as much as they would have liked. So what's happening now is the interest rates are having a bigger impact on Canadians, on their credit cards, on their mortgages, et cetera, et cetera. So now, and only now, are we slowing down on our spending. And this is actually a good thing. So we've been able to stretch out the effects, if you will, of the Bank of Canada's rate hike over 18 months. And this is why they haven't brought those rates down yet, because it hasn't had the full desired effect. They want to make sure they're quashing inflation. They want to make sure the runaway inflation is done before they allow those rates to come down again. So they may raise rates a quarter point on October 25th. In the long run, it doesn't really matter. They know that they're pinching Canadians. They just want to make sure that that runaway inflation is absolutely done before they allow those rates to come down. It is expected that they will come down second quarter or third quarter of 2024, so in the next 9 months. And Canadians will be able to breathe a little bit easier. We talk about the disinflationary measures that are now occurring, the disinflationary indicators that are happening across commodities, housing, several sectors of the economy. in our blog post. So you can check that out. Click the link in the description or the link in bio. Thanks. Have a great day.